Hi, friends. This is Colin Richards, president and founder of Lord & Richards, and I'm excited to be talking to you today about subjects related to retirement freedom. And as most of you know, if you've listened to our show, this is the focus of our work with our clients. We work with thousands of people across the area, and every single day we're meeting with people just like you who are concerned that events out of your control are going to mess up your retirement. And so what we do is we help you build a retirement freedom roadmap. And we do that from a biblical point of view so that values underpin our decisions, not just secular worldly concepts, right? We can learn a lot from great, wise people in the world, but we need to bound those by the Word of God. And so in this particular segment, we're transitioning into moving from a discussion around what the Bible has to say about debt to now the idea of investments. You know, I often say for those who are fans of Dave Ramsey, we pick up where Dave leaves off and where he probably should leave off, because Dave has really given great advice for a long time about getting out of debt and managing your finances and being a good steward. But when he starts talking about investment advice, he's really moved out of his realm of expertise. Now, I'm not saying he's not a good investor. He's a real estate investor, but that's a little bit different when we're talking about investing your portfolio. It's not as simple as just throwing it in a mutual fund and expecting a 12% or 10% return. That's just not how the market works, and that's not how mutual funds work. Mutual funds put tremendous drag on the performance of your assets through generally high fees compared to other ways. You would do far better if you're going to invest in the market to just own an exchange-traded fund or a series of funds that mirror the movement of that index that a mutual fund is trying to mirror. And so it's really an inefficient way to invest, folks. And so this is why I say we're going to pick up where Dave should leave off, and we're going to talk about how to invest as a retiree or a future retiree so that your money will last. And it's not as simple as some make it out to be. For example, for a long time, investors have been steered generically into what is called the 60-40 portfolio. And that really can be adjusted to 70-30, 40-60. It means the proportion of stocks to bonds in the portfolio. A lot of people do this through their work. They use what's called a target date fund, and they're told, okay, just put a certain percentage in stocks, a certain percentage in bonds, and it'll be just fine. Stocks will give you the exposure to growth. Bonds provide the exposure to income and a relatively lower degree of risk, or so we're told. And this is the most common allocation, 60% stock, 40% bonds. And it's considered moderate by most financial advisors. And the way they assess their clients, a majority of people land there. Think about it. When you're asked the question, are you aggressive? Well, no, I don't want to be aggressive. Or, well, are you conservative? Well, no, I want to grow. So I guess I'm moderate, right? And so this is where most people wind up. And it's considered somewhat diversified because the prevailing wisdom has always been that stocks and bonds tend to not move in the same direction, especially when the market goes down. Well, guess what? Over the long haul, 100 years, the annualized returns of this type of portfolio were okay. But the problem was we realized over several periods of time in the last couple of decades, or the last 26 years, that bonds, in fact, do not mitigate the risk as we expected them to do. It is possible for both stocks and bonds to go down in the same year as they did in the 2022 bear market. So think about 2007 to 2009, 14 of 16 asset classes were down all at the same time. Okay, in recent days, the government spending policy resulted in inflation, and that created a need to cool down the economy. And how does the government do that? They make money less available. They make it less easy by raising interest rates so that it's harder to borrow money. Well, guess what? Long-term bonds, which people have in their 60-40 portfolio, up to 40% of their portfolio, which are considered safe, are especially at risk when rates rise. Yet nobody reacted to that. The bonds that we hold are worth less than the new ones that are issued at higher rates. And so we saw long-term bond portfolios drop by as much as 25% when everybody thought they were safe. Meanwhile, economic headwinds came into play. The war that began in Ukraine a few years ago delivered a punch to stocks, and stocks delivered a similar downside return. So the government's long-term policy of keeping rates low has also punished bondholders and those with 40% of their portfolio in bonds. So whether the interest rates are low and therefore the bonds aren't yielding that much, or they're high and the bonds you own are now worth less, it's a catch-22. So what have advisors been doing? What have people been suggesting? Well, some advisors have been gradually switching their clients to a higher percentage in at-risk assets. You know what that means? The American people have been moving their money more and more into aggressive portfolios, feeling like the low rates in the recent past were just unfairly keeping growth low in bonds. And so, of course, this resulted in clients taking ever greater risk with little understanding of what could happen just around the corner. And let me tell you, if you're within 10 years of retirement or already in retirement, you are especially vulnerable and run the risk of delaying your retirement or returning to work if the money that you rely on is whacked in half and reduced from a 401k to 201k, as it has happened frequently in the past. And so this is a challenge for retirees, especially those who need income from their portfolio may find it really hard to get consistency while you're withdrawing as markets soar and plummet. But folks, there is a better route for those who still want growth but aren't interested in shifting your portfolio to excessive risk levels, risking your retirement in order to get it. And it's really about finding alternatives for bonds, finding alternative ways to get income, finding alternatives to safety. And I want to talk to you about that in our next segment. But in the meantime, I want to visit with you. I want to talk to you about what we call a retirement freedom review. Folks, you need this. It's going to give you the peace of mind that you need in order to make a great decision about retirement. Recently visited with some fantastic folks, and this review was critical in their decision making about when to retire and what budget they could afford. And folks, it's not doom and gloom. Our team is capable of often moving up your retirement date, sometimes years earlier than what you expected, because of the creativity and alternative strategies that we use. I'd love to talk to you. My team and I would love to help you. It simply starts with a phone call.